Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek, insight from the reporters and editors that bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, we want to shift gears because one of the things that has been
You said shift gears.
So helpful.
I like that. We're going to explain why that makes sense.
So helpful is touching base with CEOs around the globe with everything that's going on. Atlassian, it's the more than $80 billion market cap enterprise software company behind Jira, Confluence, Trello, and more. The company has more than 300,000 customers around the world. It's got a great view when it comes to tech spending among businesses, both big and small. Company was co-founded by Mike Cannon-Brookes. He's also CEO. The billionaire invests in renewable energy. He also works to combat climate change. And he's joining us right now to talk about a lot of what is going on, as well as some news that he had this week in the world of F1 racing. Mike, first of all, there's a lot coming at us right now, but we are so grateful to have you. We want to get to the F1 news, but we also want to ask you about the macro environment. How do you kind of figure out what to focus on, what not, when things are coming? Certainly geopolitically, we are talking a lot about tariffs and a tariff war, essentially. How do you take it all in, and how do you assess today's business environment globally?
Sure, guys. Thank you. Thank you very much for having me.
Yeah.
Look, there's no doubt it's a busy world at the moment, isn't it? There's a lot going on. My strategy has been almost ridiculously simple most of the time, which is just to work out what the business needs. And normally the best way you can figure out what we should spend our time on in a given day is to look at your customers and go talk to them, right? And that doesn't mean it's simple. They are facing lots of different global effects in parts of the world. And so, if we work out how we can help them, that usually is our simplest way to gain some focus in an otherwise highly confusing world when there's a lot going on.
To what extent, though, do you have to increase your value to them because their margins get squeezed as the result of tariffs, as the result of a potential trade war? What do you have to do to prove to them that you're worth spending money on?
Sure. Look, Atlassian's products are all about collaboration and efficiency for companies, right? We help teams of people. Our mission is to unleash the potential of every team, has been for decades. And our job is to make sure that we explain to customers how our software can do that, then have those customers adopt the software, whether they're running projects, whether they're looking at their strategic plans, whether they're building technology, whatever it is that they're doing, we help them make their technology teams work better with their business teams. And we have always been an incredibly value-conscious offering. You get an incredible amount of value from Atlassian for a very low price. And that helps in tricky economic times, but fundamentally we have to justify with the customers and have them demonstrate to themselves, ideally, the value of our software and how it makes them more efficient and work together. And that's where I think we've kept a pretty clear North Star for a long time, and why we have 300,000 customers and are still growing strongly at the size we are today.
Well, those 300,000 customers, all over the world, when you hear updates from your global sales force, are you hearing from them about any particular concern in different regions of the world that could be affected by tariffs, that are seeing weakness for other reasons? What's the read that you have on the globe from your sales force?
Look, there's always challenges in different parts of the world. This is not new. I think in any given small slice of time, we see that. We have very global companies, we have very local companies in that 300,000. Our customer base has always spanned small businesses through to very, very large businesses, some of the largest companies in the world. In fact, we have like 85% of the Fortune 500 as customers. You have a lot of issues going on for a lot of different companies. Our job is to make those companies more efficient. They still have to deal with those issues. They have to run projects and collaborate and communicate with each other. We help them do that. We always have. And so whatever issues they're dealing with, whether it's an issue of growth, whether it's an issue with a tariff or a challenge, Atlassian's trying to help their teams deal with that issue more efficiently. If we can't demonstrate that value, we're not going to be around. So again, just sticking to that as a North Star has been a very simple principle for a long time, guys.
So, Mike, no, you're not seeing any signs of any kind of slowdown or pullback by some of your customers as they kind of wait for the dust to settle. I mean, we certainly feel like we're in it, as we have kicked off a new administration here and every day are dissecting different headlines that come out of the White House. But, there's geopolitical turbulence, as you well know, around the world. And I think there's, dust that needs to settle in different places. So is there any signs of any hesitation that you're seeing among customers or not yet?
Look, from our point of view, we continue to see, really good growth across our customer base, and especially in the enterprise segment. So our largest customers, those organizations with more than 1,000 people around the world, we have more than 500 customers that spend more than $1 million a year now with Atlassian, and that is our fastest growing customer segment. So I'm sure that those businesses are having to deal with all of that dust in the air, as you talked about. But at the same time, they have their own customers to deal with. They still have their business to run, and whatever the problems are, they have to deal with it. And so our software helps their teams deal with whatever it is that they need to do, how they handle their customers, and also how do they handle whatever is going on in whichever part of the world. As long as we keep that value ratio great for our customers, we invest very heavily in R&D and continue to develop and build our software every single day. We have a fantastic team. I'm not sure focusing on all that sort of thing is very helpful for us or for our customers, to be honest. They have their own customers to deal with. And
I should point out, last month you guys reported second quarter results that beat expectations. You raised your full year forecast, and investors have definitely rewarded you big time. The ADRs that trade in the United States are up more than 50%. Tim, in the past year.
I just want to remind everybody, we are waiting for President Trump. He's making comments in the Oval Office where he's been speaking for the better part of close to an hour at this point. We'll bring those comments to you as soon as the tape playback starts. It is Bloomberg Businessweek. That's Carol Massar. I'm Tim Stenovec. We're speaking with Mike Cannon-Brookes, the co-founder and CEO of Atlassian. Mike, I do want to talk a little bit about different industries that you serve. We talk a lot about AI. I know you guys are doing a lot with AI. As far as customers go, customers that are using your product, customers that are leaning into AI right now, are you seeing more growth on the tech side of your business in terms of those types of customers, given what we're seeing come from the tech community over the last couple of years?
Well, great question. AI is a huge topic among our customer base. From Atlassian's point of view, we certainly believe all of the progress we're making in AI every week and every quarter at the moment is fantastic for our ability to achieve our mission, right? We can build better and better products that more tailor and are customized to the work that our customers are trying to do. There's no doubt our core customer base are what we like to call technology-driven companies. So companies that believe, like Williams Racing or like a financial services company, they'd both be the same, that believe technology is their source of competition. It's the way that they are going to get an edge, survive, or thrive in their industry. Any of those businesses are deeply investing in AI in lots of different ways. They are trying to work out how this technology makes them more efficient, how it helps them to compete fundamentally. Atlassian's role there is to invest very heavily, as we have done, in the R&D of actually bringing AI to our customers. So we're a big believer that if we don't ship software that people can use, the rest of it doesn't matter. It's all just kind of talk. So our investment has been in taking those AI innovations and developments every week, every month, incredibly rapidly, and getting them to our customers in a form that they can use. We have done that, and it's one of the things that the Atlassian Williams Racing team's most excited about. It's one of the things that all our customers are talking about, is how they can make their businesses more efficient, especially as you mentioned in the current times, which is a big challenge.
One last question about AI before we talk about some of the news you guys had this week. Our Bloomberg Intelligence team, our in-house group of analysts, noting that it may threaten your seat-based sales model. They say DeepSeek's cost-effective model of training LLMs can bolster AI adoption, driving a shift of work to digital agents from humans. And so they say that's a risk for some of the enterprise software players with seat-based revenue models, including yourself and some others. So could the DeepSeek have an impact like that on your business?
Look, we certainly deeply believe in the fact that agents are going to make a huge difference to businesses around the world. We're already seeing that. We are very much on the leading edge of that technology. We shipped our product Rovo almost a year and a half ago now, and have continued to update it, and have now more than 1 million users waking up and using Atlassian AI technologies, including all of our agents every day. I think we take the position that AI fundamentally is about unleashing some form of human creativity, right? It lets people do more with less. It helps them to be creative. It's a fantastical tool. That tool, there's no doubt, makes people able to do more. You can write more software, you can answer more emails, you can do whatever it is that you want to do, and you can do it more creatively and at a higher level. The thing with most of the industries that we work in, right, we sell to knowledge workers around the world, people that spend their days sitting at a laptop or behind a computer and using, fundamentally brain creativity to try to improve whatever business they're working in. Those are usually not supply limited by human creativity. If you take software engineering as a field, if we made all software engineers in the world twice as effective, the question is, would we have half as many software engineers, or would we build twice as much software? I think we'd end up building twice as much software, not the other way around, because we don't have a shortage of ideas of what we would like to build in the world.
Right.
Most businesses don't get everything they need to get done. All our agents are doing is helping those businesses to achieve more, and they'll all be competitive with each other as well. So there's a natural law of sort of conservation of profits there as well.
Hey, Mike, I don't have my glasses on, but you're hot. I want to talk about, some news you had this week. And this is your partnership with Williams Racing, the F1 team. I believe it says that on your hat. Does it say that?
It does.
Yeah, it is.
Forgive me. Like I said, I don't have my glasses on, and there's some distance here as I look back at our feedback monitor. Tell us about this partnership and what you guys are going to be doing and why you wanted to do it.
It's an incredibly exciting partnership for us. It's from an Atlassian point of view, it's the first major brand deal. From the Williams point of view, it's the first time, it's the largest deal they've done. It is the first time they've had a title partner and a technology partner. Look, obviously Williams is an amazing storied race team, right? One of the winningest teams of all time, and has had a challenging, last decade. However, there is huge renewal going on in the Atlassian Williams team, right? This partnership is just one step. New partnership, new driver, new principles, new ownership, huge investment in digital transformation and technology as a way to catch up and to win. We are, I think 80% of the teams on the grid or more are Atlassian customers and have been for decades. So this is a sport where technology is really important. It is a sport where technology teams, those building, fluid dynamics models and wind tunnels and cars and all of the monitoring technology that goes into it, have to meet with the business teams, those in the sponsorship groups. So our fundamental system of work is what the company, what Atlassian Williams is trying to do and trying to embody. We then, obviously it's a global sport, we have customers all around the world. But more importantly, having spent a lot of time now over the last 6 months with the Williams team, this is a really great cultural fit for Atlassian. This is a team of people who are working incredibly hard every day to use technology to try to change their fundamental outcome. They're on a massive journey of rebuild. The culture, the palpability of getting back to the winner's circle is phenomenal. And we fell in love with the story, and we're like, okay, we can help you do this. So we're leaning very heavily into technology partnership. We have a lot of things we can help them with to make their business far more efficient, and hopefully, change the results of the team, which is a mission that Atlassian now has thousands of people working on. So really excited about that.
It's a long-term deal. It's been described as a record-breaking deal. Just for context, can you give us some of the numbers behind this deal? How much it cost?
I can't, unfortunately. I can tell you that it is certainly a long-term deal. We are on the Atlassian Williams journey, right? We are trying to use all of our software and all of our technology and all of our culture and our practices of how we work to show fundamentally our customers and to show the world that we can make a massive difference in what is obviously an incredibly competitive industry, right? It comes down to hundreds of milliseconds. The gap between first and last on the grid in the last race of last year was the smallest it's ever been.
Okay, so we don't have the details on the exact figures, but how do you justify ROI on this, given that it's such a big deal, and it's kind of hard to measure how many people will become Atlassian customers as a result of this title sponsorship?
Look, we always have been an incredibly metric-focused organization. As a large bootstrapped company, you don't get that way without counting numbers very, very carefully. Look, we have a number of success metrics here. Firstly, always from a brand point of view, Formula One is a very fast-growing and global sport. And we have, as I mentioned, customers in almost every country on the planet. So we need to continue to have our brand and our presence and our story told in a larger and larger way around the world. But that's obviously worth a lot of money to us. Secondly, as an enterprise opportunity, the Formula One is, it's like a mobile executive briefing center, right? It takes its business. This is a fantastical customer of Atlassian that we can take to 24 cities around the world.
Right.
And in those 24 cities, we can bring our biggest customers to show them how Williams works, what we are doing to help the team. And this is incredibly powerful in the enterprise to be able to show real world examples.
Right.
Of what we can do to help a customer.
Mike, just real quick, one last question. The Formula One, the FW47 car that's going to have your branding, I guess it gets unveiled, I don't know, really soon. Are you going to be able to take it around the track? Have you been told that you could, or?
Look, my driving skills might need a little bit of work for that one. I've certainly sat in the car, and let me tell you, that is a challenging job. That is not as comfortable as my daily driver, that's for sure. It does get unveiled on Tuesday, and we're certainly really exciting. We've done some really innovative, actually, I think, for Formula One design work between the Atlassian design team and the Williams design team. So super excited to show the world the car on Tuesday, and super excited to show how we're trying to bring our collaboration and teamwork practices, right into that car, in fact, and into the garage and to all the mechanics and all the strategists that work on the race as well. So we're not just a digital company. You'll see on Tuesday.
Don't totally need AI for that, right? You just need a really cool car. Just gonna say.
Need a lot of things to compete in this sport. So we're on the journey. We're learning a lot, and we're putting our shoulder behind it.
Carol, I do feel like if you sign the check, you can drive the car.
Yeah, I'm just gonna say, Mike, you do get some leverage with all of this. I'm just gonna, and the company name's gonna be on the car, so you should be able to take it out for a spin.
Look, I would also say it might not be a good idea for the Williams team or the Atlassian team. I'm not sure if my risk team would think that's a great idea for me to be driving at 300 or more k's an hour around a track.
I hear you.
Not qualified to drive.
Listen, thank you so much. We know it's later where you are, but we so appreciate you joining us on this Thursday. Really, really appreciate it, and good luck with that partnership. We've been, of course, talking to Mike Cannon-Brookes. He is CEO, co-founder of Atlassian, and, of course, talking about the new news that they had, their deal, their partnership when it comes to F1 racing. So some really cool thing with the Williams team.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Another headline from the president. I'd love to have President Putin of Russia back in the G7. He also says, I do believe that President Putin really wants peace. And of course, he's referring to the war between Russia and Ukraine, Tim.
Well, Bloomberg Economics calculates that protecting Ukraine and expanding their own militaries could cost the continent's major powers an additional $3.1 trillion over the next 10 years.
All right, let's see what our guest has to say. Let's head to London. And Monika Bičkauskaitė, she is the public policy director of the strategic consultancy firm Key Element Group. Monika, so good to have you here with us. President Trump, another headline from the Oval Office. Russia should be sitting at the table. What are the tea leaves we need to read in terms of what we are getting from President Trump today, and also knowing that President Trump spoke with President Putin yesterday?
Yeah, so the call between President Trump and President Putin has shown that they're communicating directly, which means that Ukraine has been sidelined. Ukraine is not part of the conversation about its own future. And as you said, right now, it seems like there's normalization with Russia, the relationship with Russia, and Russia will be back at the table, which in a way is unprecedented in the 21st century. You haven't seen another leader attack a country in Europe and be back at the table after killing civilians, after committing war crimes. So what we're seeing right now is unprecedented, and we're seeing Putin, who's being really emboldened, strengthened, and he can cling to power for many years to come because now he will have a huge victory.
Just to recap, so Russia should be sitting at the table. He also says that Ukraine will have a seat at the table. He says he wanted to make sure Putin wanted to do a deal. That was earlier in the day. So again, we continue to see things. Do you think Russia's in the driver's seat with this and that it'll be more favorable to him in any deal? I don't know. Can you tell from some of what we've been getting over the last couple of days?
Yeah, so the fact that the call was between the two leaders, Trump and Putin, already shows that the conversation was more direct and Zelensky was not involved in this conversation. We have also seen a response from European countries that have been saying that we should also be included because, this is about security of Europe, not only security about Ukraine, and they have not been included yet in the conversation. So we see that the decisions are being made already in a way, and we saw the Defense Secretary of the US talk about possible conditions of this deal. For example, no NATO membership for Ukraine, no US troops on the ground in Ukraine, and Ukraine having to accept territories that it has lost. So we are already seeing this deal shaping up, and the way it is shaping up right now, we see that Russia definitely is the winner here, and Russia is getting exactly what Putin has wanted. And we could also see that Russia will not have sanctions on itself anymore, and then the oligarchs will also be supporting Putin, who will then be able to stay in power for many years.
Given what we've learned from the president over the last few days, including just in the last few minutes in the Oval Office, Monika, how do you think this war ends? Does it mean land from Ukraine going to Russia, perhaps natural resources to the United States in exchange for some protection? What's your view?
So I think that, right now we only have the public information that has come from the US about possibility of ending this war. And yes, under this possibility, Ukraine would lose territories that Russia currently controls. But I think another aspect that nobody is right now talking about and is very, very important is the impact that the end of war would have for decades to come. And I'm talking about Ukrainians and Ukrainian population. You had Ukrainian population that was fighting for 3 years in this war, and they were fighting for their own freedom, but for also being part of Europe, of the EU, of NATO, and for freedom of the West. And how they will feel betrayed if this is how the war ends, and the terms are really unfavorable for Ukraine. And when you have the satisfied population, you have the anti-Western sentiment. What I'm afraid of, and some people in Ukraine are afraid of, is that this creates a really fertile ground for future manipulations from Russia and potentially even installing a pro-Russian government.
One thing I want to ask you, Monika, that if the U.S., is basically, saying that the European allies, they have to shoulder most of the burden for any settlement. And as Tim mentioned earlier, we're talking our own Bloomberg economics team that protecting Ukraine and expanding their own militaries could cost the continent's major powers an additional $3.1 trillion over the next 10 years. If the U.S. is backing off in terms of financial support to its European allies, what is likely to prevent President Putin from maybe waging another war, going after another border at some point, other territories?
So I think what was very important that President Trump has said is that European countries really need to invest in their own security and increase their defense spending. And we have seen now, for example, Latvia, Lithuania, and Estonia, the Baltic countries, they're increasing their defense spending to 5%. And of course, these are small countries and they don't have huge budgets for it. But other European countries should follow this example and also increase their defense spending and their budgets to be able to, defend themselves if the time comes. But also a very important aspect I want to mention is the the reconstruction of Ukraine that will create a lot of opportunities for also American businesses to be part of this reconstruction and to benefit financially in the future from it as well. So I see two coins, of this argument, and I think that reconstruction is something that should be considered. As you mentioned, rare earths potentially could be a deal between U.S. and Ukraine, or European countries and Ukraine. So there are definitely avenues to be explored on financial side as well.
Monika, thanks so much. Gonna have to leave it there. Monika Bičkauskaitė, she is Public Policy Director of the strategic consultancy firm Key Element Group.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
As we've been reporting throughout the day, we're all in on kind of understanding what's going on with these reciprocal tariffs. Just to remind everybody, President Trump ordered his administration to consider imposing reciprocal tariffs on numerous trading partners, raising the prospect of a wider campaign against a global system that he complains is tilted against the U.S. Ali Furman is consumer markets industry leader for PwC, and like many of us, I think I can say our colleagues at Bloomberg Economics have been doing this quite a bit.
Yes.
Crunching the numbers to try to get a picture of the impact of these tariffs. She joins us from New York. Ali, lots of work for the folks with the calculators today. What are the calculations that you've seen at PwC as to how much could be affected by these tariffs?
Well, first of all, thanks for having me again. It's great to be back, Tim and Carol. Listen, we've done some industry impact analysis across all industries, looking at the upper end of the tariff ranges that Trump talked about during his run-up to the presidency. And we estimate that tariff revenues could increase from $81 billion a year to nearly $900 billion a year. Which is our figures that don't take into account countermeasures that trading partners may impose in reaction to U.S. policy changes, but that's just taking into account the upper end of the ranges that he talked about prior to any of the executive orders that were actually signed. But that's quite a significant jump, 81 billion to 900 billion a year.
So the folks that you talk to, clients that you have, are they starting to freak out?
I wouldn't say freak out. I think just over the last, I would say 10 business days, we're seeing a lot of companies move from kind of a planning / wait and see phase into a take action phase. So we're seeing, everything from setting up the ability to dynamically model some of these impacts that are very fluid, taking into account things like ACE customs data, which every company has, that's data around their imports, to data from their financial systems, trying to understand, frankly, what the competition where they import from, to just get a broad sense of different scenarios and how to think about things like supply chain dependencies, raw material sourcing, looking at transfer pricing strategies, looking at supply chain optimization moves, manufacturing optimization moves. It's just it's a fluid situation. So being able to evaluate it real time with dynamic models that allow for different inputs and levers to assess, what strategies to prioritize. That's a really common way we're seeing companies like retailers who are affected by this and consumer packaged goods companies.
Wait, so Ali, is that a freak out or not?
I mean, I don't think it's a freak out, but it's a planful way of, considering our options, I would say.
I mean, can we say, like, after decades or years easily, but definitely decades, I mean, there's been a lot that has been said about, going to the low-cost provider, especially for manufacturing. I think about the retail industry, and how that made good business sense, right? And so much stuff was offshore. I mean, is this possibly a moment in time where people have to really rethink their supply chains, and in an environment that where even our trading partners and those that we get along with, that it's a complicated relationship?
My answer is yes. It is a moment in time to rethink suppliers and also supply chain footprints. But keep in mind, neither of those two things are like flip a switch and you can change them all tomorrow. They're kind of longer term mitigation strategies to these tariffs versus shorter term. In the short term, the impact that tariffs are likely to have on companies is margin erosion, particularly some of these companies that have thinner margins to begin with.
For example, give us some examples.
So apparel, clothing, relatively thin margins, right? So you have to think about ways to mitigate margin erosion, even outside of direct tariff mitigation levers, like we just described around supply chain optimization and moving your manufacturing operations out of China to other Southeast Asian countries or back into the US. So you think about ways to mitigate margin erosion, you think about cost cutting in, functional areas where you can maybe leverage AI or other types of emerging technology to make your processes more efficient and get some cost out of the business to try to hedge some of this tariff impact. Because I'll tell you what, today's market from a consumer perspective, 2025 is very different than it was in 2018. Consumers are fatigued from going through this inflationary period with shelf prices increasing 30% in the last 5 years. It's going to be very hard to pass on all of this tariff impact to the consumer of today and not see a negative impact to your volumes. So you really have to think about other strategies to employ. Some of this is likely to flow to the consumer, unfortunately.
Do any of those strategies include moving manufacturing to the United States?
For sure. But that's a longer term proposition. It's not something that is going to be able to just quickly be implemented in the short term and see the ROI of doing that. It's a complicated situation to move your manufacturing from Asia to the United States.
But in some cases, it's not even possible. I mean, we have a story later that we're going to talk about. The company Shark Ninja, they make the Ninja Creamy. My sister got one of those for Christmas, by the way. Really? Yeah. Your microphone's off.
Oh, sorry about that.
Really, she got it.
And?
She loves it. That's what she asked for from everyone.
But if she was buying it maybe with tariffs, or if somebody was buying it for
Santa Claus.
Oh, okay, sorry.
Doesn't have tariffs. The CEO told Bloomberg that they're not moving to the U.S. Here's what he said, quote, "Our industry doesn't exist in the U.S. The product is not made here. The components are not made here. It's not like the car industry that you could say, well, let's flex it back to the United States. It's not something we believe is on the horizon." How many more of those types of companies are out there? I mean, you're not going to have C apparel be made in the U.S. on a wide scale basis.
Correct. Niche markets, smaller retailers, like American Giant might see, some additional market share from this. Think about small furniture stores that may be, U.S. based, wood supply companies, local butcher shops even could benefit from this in the short term. But yes, no, you're right. The move to U.S. manufacturing is not applicable to all industries or, all types of products. So it cannot be relied on as the sole, tariff mitigation measure. It should be evaluated, amongst many other things that companies are considering doing.
All right,
pricing strategy is another one. Yeah.
Oh, okay. Cool. Thank you. Thank you so much. Ali Furman. She is consumer markets industry leader for PwC, joining us right here in New York City.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
We are all in on tariffs today. I mentioned this, I think with Jon Taffer, or even earlier. Yeah.
We talked about it with me.
We talked about it with you.
Shark
Ninja. They make the Creamy. They have said that they're largely cutting out China in its supply chain for the U.S. market as tariffs increase costs, but it's not going to make the products in the U.S. The company's CEO, Mark Baracus, told Bloomberg that our industry doesn't exist in the U.S. It's not like the car industry. The components are not here. You can't say, let's flex it back to the United States. It's not something we believe is on the horizon. Companies adjusting their supply chains is our next guest specialty. Crisp is a platform that analyzes data across the supply chain. Think retailers, distributors, and brands. Ari Traasdahl is the founder and CEO at Crisp. He joins us here in the Bloomberg Interactive Brokers studio. Remind everyone of where you touch the supply chain, where you come into it.
Great, yeah. Crisp works across the entire supply chain. We have about 6,000 CPGs and food companies, pharma companies on the platform, and help them kind of understand their retail sales across 250,000 stores, pricing, distribution, inventory, etc., but also kind of through the supply chain that they have behind them.
Does it go all the way back to where it was created, the ingredients that go into it, or does the supply chain just start once it hits a certain geographical area and that distributor gets to the US, gets to the store shelves?
Yeah, but typically we use closer to consumer, so it's retailers, it's distributors, and it's large manufacturers. But large CPGs that we work with, they might have 150, 200,000 suppliers that are from domestically and from internationally. So they leverage our data to plan through their entire supply chain.
Is there anything you can see already where, or maybe in your conversations with some of your customers, are what you are hearing in terms of what we're getting out of the White House, tariffs, threats of tariffs, and whether increasingly they're thinking about or rethinking where their global supply chain has to be, and whether or not they're creating redundant supply chains to make sure that they're in a good situation or a good place?
No, yes, absolutely. It is supply chains react poorly to uncertainty, and we saw that during the pandemic as well. And similar behavior as consumers have, we see the similar behavior on professional retailers and professional manufacturers and distributors. It's to make sure that you have enough of these products. So the cost that we're going to see in the supply chain is both coming from the increase of the cost of the ingredients, but it's also coming from the cost of just these challenges rippling through along supply chain with overstocks and understocks, and we can remember all of this from the pandemic. So we're already starting to see those type of shorter-term initiatives.
So did we not learn anything?
I'm not sure if we learned anything. We learned a little bit.
Did we learn, make the PPE here in the U.S.? Did we learn that?
Like, did any changes come about where people substantially changed their global supply? I feel like we've had conversations with people who did some rethink.
I mean, there's been a lot of nearshoring. There's been a lot of, if you go,
increasingly,
and Businessweek has written about this, the rise of factories south of the border, Chinese factories being built in Mexico, but
absolutely.
And some of it just makes sense to be closer to where you're selling.
Yeah.
Yes, absolutely. So we saw a lot of that after the pandemic, and I saw a lot of investments in technology actually, because it's not like we're starting out with a very robust supply chain in the first place. Take food alone, which is kind of one of the big parts of what Crisp does. A third of all the food that's made in the world is lost in the supply chain, just of inefficiencies and.
Well, that's ridiculous. So with all the technology we have, you're just saying in the process, in just moving it around, we lose a third of all the food that comes through the supply chain.
Through spoilage? What's
through spoilage? Yeah, through spoilage from all the way from where it's grown to it's exported to it's imported to productions of 1/3. At the same time, you have 1 billion people that live with some kind of food insecurities in the world, right? So which is the one part of this. But these supply chains are really not very robust. So, and when these things happen, like a pandemic and what we're seeing now as well, my concern, in addition to the increased prices, is also these kind of big ripple effects that go through the supply chain.
I'm blown away by that.
So
the other thing is, I think about when I grew up, you had seasons where you got things, right? Now I'm getting, strawberries in the middle of, or at any time. Maybe there's something wrong to that.
Well,
because if I'm thinking, if we're moving shipping stuff around and we're losing so much of it, that just seems like such a bad thing.
Yes.
It's also not good for the environment, the waste. I mean, the spoilage.
Yep.
If you come to California, strawberry season is every time of the year.
Yeah, but that's California.
Yeah.
Apples,
I will tell you
apples
that
were the fall.
The grapefruit I ate today had a sticker that it was from Israel.
Yeah.
Mm-hmm. Yeah, absolutely.
So how do we solve something like that? Or are we not going to? Because people have gotten used to, I can get anything I want at any time of the year.
I believe so. The consumer behaviors has truly changed, and they want to have all the products at all time. And with that, you have to have global supply of these products. The other component I find interesting is also the building materials. We always kind of think about, avocado is going to get more expensive, or eggs are going to get more expensive, but also it's as we see kind of firsthand, is that a typical CPG product has 15 to 20 different type of ingredients. So if you have shortage or higher prices and all that, there's a lot of decisions that needs to kind of happen based upon just build the materials as well. So it's not only the 15% of the product that are directly impacted, but it's also all of the products that are indirectly impacted.
Does your platform also handle recalls?
Yes, so it's chargebacks, recalls, and things that need to come back from the retailer. We also see that type of
Is that
data.
happening more and more? Is it happening less? I'm always shocked when I see a large-scale recall and the scale of it.
Yeah.
Everybody throwing away a certain bag of spinach or something. Or this week it was tuna that was bought at different stores, had to be thrown away.
Absolutely. No, we see all of those type of things. Seasonal products at the end of the season.
But is that happening less?
I think it's quite stable. We saw a lot of it right after the pandemic because you had so huge swings on everything. But I will expect that to increase a lot now.
Really?
Every time you get these ripples, the consequences are typically the recalls.
How much does the waste in something like food add to the cost of food? And just got about 30 seconds.
Very good question. So at least a third of the food in the supply chain is lost. So the waste has huge potential for the reduction of consumer prices. So can we think about it as a 20%, 30% reduction of consumer prices if we just could get this under control? The other part is also assortment and package sizes. It's very complex. If you go into a retailer, you typically see 50,000 different products merchandised by one retailer.
It's overwhelming.
And the retailers have had a lot of initiatives around reducing that and rationalizing all of these products as well. But the consumer product companies, they want to make more products, more flavors, more sizes.
I'm overwhelmed. Right? I go to the supermarket. I'm like, I just want plain water. I just want plain this.
Buying water at the supermarket?
No. Well,
okay, good.
Not really. I got a filter at home.
Okay, good.
But I'm just saying.
We can talk about that.
Go on a plane. I'm like overwhelmed.
Oh, yeah, I know.
Ari, thanks for coming in.
Great.
Ari
Thank you so
Traasdahl,
much.
founder and CEO at Crisp, joining us right here in studio.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, yesterday's CPI numbers showed us that inflation still an issue in many categories, including food and beverage. Food and beverage was up 2.4% year over year. It rose 0.3% from the previous month. Eggs, Carol.
We talked about it.
You see the Waffle House, the 50-cent egg surcharge as a result of the difficulty in procuring eggs. How are you still have some?
I still have some eggs in the fridge.
Okay.
I want to ask what Jon Taffer has to say about kind of the environment, whether it's the cost of food and everything, which all goes into running certainly restaurants and bars, certainly if they're serving food. Jon Taffer is back with us here in our Bloomberg Interactive Broker studio. As you know, he is the author of several books, including The Power of Conflict, Speak Your Mind, Get the Results You Want. He's also the EP of Bar Rescue, which is now in its what season?
10th season, 15th year.
That's amazing. That is amazing.
Paramount Network.
Welcome back. I mean, listen, when you started this, did you anticipate at all that this was going to go this long?
No, I did not.
Yeah.
And we had what we called escalating costs. Now we have creeping costs. So it's a little slower. But, the restaurant business is such that food costs can't really exceed 30%, 33%. So for every dollar that my costs go up, I have to raise it $3 to the consumer.
Wow.
Now, there's only a certain amount of elasticity in that.
Right.
So let's say my hamburger prices go up $3. I got to increase them by $9. Now, the consumer's not going to accept that $9. So maybe I can push it to $3 or $4.
Right.
So I can recover half of the inflationary impact on my business. But in many cases, I can't recover all of it. So that's where it's eroding on our operating costs.
So what do you do, Jon? Do you make the burger smaller? Well,
you have a couple of choices. You can make the burger smaller. That's one choice. Or you can raise your prices, or you can try to redesign your menu. So for example, and this is interesting, psychological pricing and eye tracking with laser movement tells me that if I box an item on a menu, sales of that item will go up by 20%.
Unbelievable.
If I shadow or chef special, it goes up by about 14%. People have a 6% propensity to order the bottom 2 items on a list. So what I'll do is I'll take my most profitable item in dollars and cents, not percentage.
Yeah.
I'll box that one. Take my second most, shadow it. Third and fourth, put them on the list properly. I won't price anything other than 95 cents. There's no such thing as $8.25, $8.50, $8.75. It's $8.95. When I need to raise my price, it goes to $9.95. Psychological pricing. If you price at $8.50, you're leaving 45 cents on the table every time. It means nothing at that point.
Right.
So understanding these elements, I want to move you through boxing. I'm going to move you to different menu items.
Wow.
So, for example, Waffle House is infusing a 50. I would also
50
run a
cent surcharge on eggs. Right? Yeah.
I would run a special on waffles because that doesn't use eggs.
Right.
So I'm telling my friends in the breakfast business, run pancake specials.
Right.
Run corned beef hash specials. Right. Do everything you can to move the consumer away from the eggs consumption, you can do that.
You didn't mention automation, which you see the chains doing a lot right now. Are mom and pop shops able to use automation?
Well, a lot of them are a little intimidated by it, to tell you the truth, just like they're intimidated by sophisticated accounting systems and stuff. My research tells me that about 70% of the independent operators don't even have monthly P&Ls. So we're asking them to look at a capital investment or a long-term lease program, to buy technology. A little intimidating for them. So I find that they're not as eager to move into it. And interestingly, if you go to the restaurant convention, the National Restaurant Association, 5 years ago there were maybe 2 robotic booths. Now there's probably close to 100 robotic booths. Everything from French fry robots to hamburger flipping robots to everything you can possibly imagine.
But mom and pops aren't doing that yet.
Not yet, but they're going to have to at some point.
Folks, and the Chipotle's got, they've got the avocado, which helps with peeling and coring avocados and frees people up to do other things. But we're not seeing that yet for mom and pop.
I think McDonald's is one of the leaders in it, in some of the robotic French fry equipment and such. But certainly, it costs a lot less. It doesn't get sick, and it's the future of our industry. And look, we're struggling with labor, as you know, still. And we think that the no tax on tips might really make a difference for us as an industry. Really, really could solve that problem.
You think
it
happens?
Oh, we think it's going to happen. Yeah, I believe it's going to happen.
Why do you think it's a good idea? Because I think for those of us who pay taxes on all of our income are wondering, well, wait a minute, how is that fair? And I guess the other side is that let's pay those workers a living wage. And so it's not, because I feel like increasingly we're tipping everybody.
Also, who declares their tips?
Well, I don't like it when I go into a coffee store and I'm asked to tip the Batista. I mean, it's a little out of line sometimes. I went to a dry cleaner the other day and I went in to pick up my dry cleaning and it asked me if I wanted to tip the dry cleaning. So it's a little outrageous now.
It's gotten out of control.
But you think within the hotel or the restaurant industry?
Let me tell you why. Because they get an employee tip credit. So in many states they don't make minimum wage. They make $2 and $3 an hour.
No, I know.
So by not tipping them by not taxing them on their tips, we're giving them a chance at that living wage. It's really important.
Why don't we make the institution, the restaurant, pay them that living wage? Why don't we do it there?
Well, we could do it there, but that's going to increase costs. So if we look at inflation and those costs, here's the problem in the restaurant industry. It's an industry that we manage by percentage. Occupancy costs cannot exceed 12% of revenue every month or every year. It just cannot.
Okay.
Labor costs cannot exceed 30%. I'm up to 45% already.
Yeah.
Food costs can't exceed 30%. I'm up to 75% now. I have my A&G, my insurance, my utilities, all my other costs. I have waste and supplies. By the time I move that up, guys, I'm at 12-15% margins. That's all I got.
But what if we didn't have tips? And I know, who was it that tried to do it here?
Was it Danny Meyer?
Was it Danny Meyer?
I don't remember who it was.
No tips. Do you not think we would think, okay, I'm paying more because I'm not tipping? That would make it, even it out, and then people...
Possibly, but there's some fear in that as an operator.
Okay.
I have to educate the customer, and I must tell you, anytime somebody tells me I'm going to start a business and educate the consumer, they tend not to be very successful at it.
That's fair.
It's tight margins. Also, I got to share with you that the restaurant industry is the largest non-government employer in America. And when the restaurant industry hurts, America hurts.
Right.
There's a lot of consumers work for us. So keeping that industry healthy as our largest consumer is very, very important. And I look at the buyouts that car companies have gotten and other industries have gotten. The restaurant industry hasn't gotten that. So I think providing this relief makes sense for that industry. And of course, I'm an advocate for it, but I do.
Hey, Jon, you mentioned the no tax on tips as one of the policies forthcoming from this administration. How are you looking at other policies in terms of growth, in terms of helping the restaurant industry, in terms of potentially hurting the restaurant industry if prices go up as a result of tariffs and people have less disposable income? How are you looking at what's coming out of Washington?
Yeah, I've done a lot of work on tariffs. I've read a lot of white papers, and I've really tried to do my homework on it. And it's tough to come down with a hard position on knowing how it's really going to have an impact. I look at it this way. A German car company Germany is charging us 10% tariff to bring our cars there. We're charging 2.5%. Let's say we bump that 2.5% to 10%. So now the German car comes into America at a base cost point, in theory, 10% higher than their American competitor. They can't compete that way.
Right.
So they're going to have to make adjustments in distribution and operating costs in some way to be competitive again. So it's hard for me to accept that every tariff, that 10 points, is going to make it to our pockets. I think there's competitive influences and a whole bunch of factors that play a part. And then look at BMW. They built a factory in America. Look at Toyota. They built a factory in America. So I think that we have to look at this as a longer play.
But look at Ford and GM. They build cars in Canada and Mexico, and then they'll get hit with tariffs when they bring those cars in. And when the car components cross the border multiple times as a result of the manufacturing process. It's very complicated.
But I would say, who was controlling our government when we allowed Ford Motor Company to start building plants in Canada and Mexico? Why didn't we incentivize them to build them here then? So now I think we're backing into it. We have these international companies that we want to make residents.
Well, some of it is like, the globalization, right, of our world. And right, so we've got allies and we've got alliances, and we invest in your country and you invest in our country, right? That's kind of how it's all happened. Is it bad if we kind of back off of all of that, in your view?
I don't know if we're backing off on all of that. Is understanding that in a post-COVID world, every country's in a different economic place today. It's a different, we're talking about environment. There's a very different environment. Now, America's operating at a significant deficit with significant debt. We have to fix this. The world knows we have to fix it. The world doesn't want us to cave in. We're the largest marketplace in the world.
Right.
So it seems to me that the world has to accept that these changes have to be made to eliminate the deficits that we all have to make us all healthy. So can we do this together in a constructive way? That's what remains to be seen to me.
What about in your world, at the bar world, where tariffs could affect the liquor market, Mexican tequila, whiskey coming from Canada?
That concerns me. But, that Mexican tequila needs to compete, with other brands and other products. I don't have to sell as much tequila. I can move my menu and sell more bourbon. So we do have options in the industry. And I think that the marketplace is a challenge. The liquor industry is in the toilet right now. So the marketplace is a challenge for them. I think they need to be aggressive, and I don't think they're going to allow a tariff to take them down.
Yeah, increasingly, and there's a lot of interesting dynamics going on in the liquor industry.
I'm not saying I know this to be a fact, but this is just how I feel because I think time will tell on this.
In terms of policies, you talked about, a shortage of workers. In terms of immigration, and I know there's illegal versus legal, but we know the hospitality industry got really hurt, after the pandemic. A lot of people left that industry, found better jobs, better paying jobs. What's your view on immigration?
Well, I think legal immigration is important, but I think we need immigrants to come here. First of all, I don't want to hire somebody who I can't do a background check on. I can't do that. There's too much liability today, especially in the hotel industry. So I have to hire people that I can do background checks on, that I can have confidence in hiring them, that they're safe, they're not thieves, my employees are safe, etc. And right now, we don't have that. So when I look at the immigrants, illegal immigrants that have come across that I can't track their background, they're of no value to me.
Interesting.
I'm not sure they're of much value to America if we can't track their backgrounds.
I would say that someone might push back and say, well, if there's fewer people to do the labor that illegal immigrants do right now, that might pull from your labor force of legal immigrants working at restaurants and then cause your cost to go higher.
Well, I didn't use the term. I'm trying to focus on criminals. There are illegal immigrants that do have backgrounds, and you can verify who they are. I don't have an issue with that. I have an issue with the criminals or the people whose backgrounds we can't check. The ones that have gang tattoos, etc. They're of no use to the hospitality industry. So that doesn't solve our problem. The good ones do. The ones that have backgrounds, that came here with good intentions.
So you're just saying whoever comes in, you've got to make sure you understand exactly
I think so.
who it is.
We have to understand that people that come here with good intentions could be valuable contributors to our society.
20 seconds, tune in. What is that about? Real quick.
I'm doing a small business radio show. With all my experience in dealing with failure and the things I have, new entrepreneurs, I want to talk to them. Future entrepreneurs, I want to talk to them. Absolutely.
Okay?
Jon Taffer, slow your roll.
Come
Wait,
on.
this is what we do.
It's a way for, you guys are doing it a little more sophisticated. I want to really help those small entrepreneurs, those people starting out, and those family businesses.
There's so many out there.
There are.
Jon Taffer, congratulations on a 10th season. So appreciate you coming in. Of course,
Great
the
to
host
see
and
you both.
executive producer of Bar Rescue. This is Bloomberg.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. About 18 minutes left here in the trading session. You just heard Bill Maloney breaking down the trade for you on this Thursday. And we've got stocks hovering near their highs of the session. So we are definitely seeing a rally underway, up about 1% on the S&P 500, just to recap. NASDAQ 100, we are looking at a gain of about 1.2%. We've seen stocks move up today. We have seen yields back off. Right now, that 10-year note with a yield of 4.52. That despite two hot inflation prints, but the expectation is some of those components, the PPI components that go into the PCE, that I think the expectation is that that number, that inflation print, which is the Fed's preferred inflation print, will actually trend lower.
You just got to peel back the layers and look at exactly what moved it, right? And then plug that into
to have
PCE.
a favorite inflation print.
All I do is I look at the Bloomberg terminal. It tells me everything. Hey, let's see what Ben Cook has to say about this. He's portfolio manager of the Hennessy Energy Transition Fund. Ben, good to have you with us. The Hennessy Energy Transition Fund has returned, according to our own data here at Bloomberg, 18.54% annually for the last 5 years. It's outperformed the index and most peers. It puts it in the 78th percentile among its peers. Has some very familiar energy names at the top: ExxonMobil, Cheniere, EQT, ConocoPhillips, Chevron, and more. Thanks so much for joining us. How are you?
I'm doing great, Tim. Thanks for having me.
Hey, so let's start on energy and just talk to you a little bit about the Trump administration and what you see as sort of the next catalyst for energy production here in the U.S. It does seem like the president isn't necessarily 100% aligned with what the producers want to do when it comes to drilling. Thread that needle for us.
Yeah, I think that's an accurate way to describe it. Obviously, the shareholders today are driving the decisions by management teams to allocate capital in a way that is, friendly to shareholders and not necessarily geared towards growth. So, as much as the current administration would like to see the industry ramp drilling and drill, baby, drill, as Trump often says, the reality is that those capital allocation decisions, again, are being driven by companies that are answering to shareholders who like to see the return of capital proposition.
Does that change if energy prices go higher?
I think that there's a potential incentive, obviously, to increase activity if prices go higher. But again, in terms of capital allocation priorities, the industry has gotten very comfortable with the primary focus being a return of capital to investors in the form of dividends and share repurchases. And then, of course, managing drilling budgets. Ultimately, I think we'd have to see a continued commitment to the return of capital and a price level that would be adequate enough to not only deliver that shareholder return, but also provide incremental cash flow that could be redirected towards drilling.
Well, and again, it's a balance, right? You're not going to have these major integrated oil companies and everybody in the energy sector go out and drill if it doesn't make financial sense, right? There is a business formula dynamic, right, in terms of what it's going to cost to get that oil out of the ground and then ultimately what they can sell it for or what they expect to be selling it for by the time they get it out of the ground. So it's not so simple as just drill, baby, drill, right?
No, that's exactly right. I mean, the business has gotten very efficient over the last, call it 5-10 years. The development of shale resource here in the United States has benefited from improvements in technology. Companies continue to develop, the drilling, the completion process has become more efficient. These companies are doing more with less, and they're achieving cost savings as well. And so, the industry's become very resilient, and generally in the more attractive shale plays, they've reduced the let's call it the development cost per barrel. So the profit margin potentially, with a lower price could remain the same. But again, it's the profit, it's the motive by the companies to return capital to investors. I think that is the primary objective going forward.
How are you looking at potential tariffs on Canada, specifically with regard to energy? How does that work in your world of these energy companies that you follow? Because a lot of that oil comes to the U.S.
Yeah, sure. It sure does. I mean, over 4 million barrels a day is imported into the United States from Canada, and it certainly is a meaningful contributor to the refining appetite for crude oil in the Midwest. And, it's not clear though that an immediate uptick in pricing will be fully borne by the U.S. consumer. Consumer behavior ultimately will determine how much of that increase in that tariff or the imposition of that tax will affect the price here in the U.S. We could potentially see the U.S. refining industry, particularly in the Midwest, resort to switching to supplies from the Rocky Mountain region or even the Bakken Shale region. So that's a possibility. On the other side of the border, Canadian producers could lower their price as well. So, in terms of tariffs, whether it's Canada or our Asia trading partners there, it really have to look at it on a country-by-country basis.
The president said just in the last couple of hours from the Oval Office, Canada will be a very interesting situation because we just don't need their product. And yet they survive off the fact that 95% of what they do, Canada, then he goes on to talk about taxes in the 51st state. But do you agree with him that we don't need their product?
Well, at the end of the day, trade relationships are important, obviously, for a variety of reasons. And I think, there's a lot of negotiating tactic that's embedded in these tariff headlines that we're continuing to see. Could we switch fully away from 4 million barrels a day of imported crude product from Canada immediately? I suppose we potentially could. Over the long term, it would come at a cost. But the point remains, I think the Canadian volumes coming into the United States are very important for our refining industry. And, it'd be likely a difficult transition for us to make to fully switch away from that crude.
I am curious, since it is an energy transition fund, and I did see the biggest utility in Virginia, home to the global hotspot data center alley, saw demand from data centers in development almost double in the last half of 2024. So I do wonder about how you are thinking about the AI play in particular. Certainly some questions came to the forefront after DeepSeek came out a few weeks ago and just looked like it could do AI, a model comparable to potentially ChatGPT, but less expensive and not requiring necessarily all of the energy. Just got about 30 seconds. Are you rethinking that and the impact that could have on some of the energy players?
No, not rethinking that today, Carol. The reality is what we're hearing from the companies across the natural gas value chain, whether it's producers, midstream operators, or even the utilities themselves, is the demand for data center build out, ultimately the natural gas that will power the power generation needed to fuel those data centers. It's a very significant growth driver, and we'll continue to see very impressive growth rates in the electric utility industry. Over the balance of the decade, we'll likely see growth rates in electric demand on the order of 1.5% per year, which compares very well relative to the last 10, 15 years of roughly flat electric demand growth. So the trend is very strong. Don't see any reason to believe that's not going to continue.
All right, got it. Ben, thank you so much. Ben Cook, portfolio manager at the Hennessy Energy Transition Fund, joining us from Dallas, Texas. Do not go anywhere. We're counting you down to the close on this Thursday.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.